Just weeks ago, silver rocketed to an unprecedented $93 an ounce. That was a 150% surge in a single year. But then, in a single day, it plunged 7%. What in the world is going on with silver? Is this an incredible opportunity or a dangerous trap? Today, we are pulling back the curtain. We will dissect the raw numbers and dig deep to reveal the true story behind silver's explosive volatility. We will explore its underlying fundamentals. These quiet forces were at play even before the recent drama. Most importantly, we will tell you exactly what you need to know. We will highlight what questions you absolutely must ask yourself.
And we will cover what moves you need to consider for yourself. This is all before you even think about putting a single dollar into this wild, wild market. To truly grasp the recent chaos surrounding silver, we need to rewind a little.
We must understand a powerful, yet often overlooked piece of American legislation. This is the U.S. Trade Expansion Act of 1962. Specifically, we are talking about Section 232. Imagine for a moment that America's economic front door has a special heavy-duty lock. Think of it as a national security lock. That lock is Section 232. It grants the President of the United States the extraordinary authority to investigate imports of any article. This is if they are deemed to threaten national security. If that threat is confirmed, the President can then impose tariffs, quotas, or other restrictions on those imports. This power has been used before. It is a broad power and one that has been used to significant effect in recent memory. We have certainly seen this mechanism in action before. You might recall when President Trump first used Section 232 back in 2018. He imposed 25% tariffs on imported steel. He also imposed 10% on aluminum. The reasoning then was to protect domestic industries vital for national defense. More recently, similar, albeit steeper measures applied to certain copper imports. Tariffs as high as 50% were levied. Each time, these decisions sent ripples. Sometimes they sent tidal waves through global markets and supply chains. But now, something truly significant has happened. Silver, the same precious metal often associated with jewelry and coinage, has officially entered these national security crosshairs. So, why silver? Why now? The turning point arrived in November of 2025. That is when the U.S. Geological Survey, or USGS, made a pivotal update. The USGS maintains the official list of critical minerals. They expanded their list, adding silver to the ranks of other strategically important elements like copper and uranium. This was not just an academic exercise, it was a game changer. Overnight, this seemingly bureaucratic tweak elevated silver's status from a mere commodity to a critical mineral. With that designation, it immediately became a potential target for Section 232 tariffs. This placed silver directly in the line of sight for presidential action. This single update, almost silently, laid the entire groundwork for the dramatic price swings and market frenzy we have witnessed in the weeks since. It set the stage for the silver market's wild ride. This ride has been dictated more by political decrees than traditional market fundamentals. Then, on January 14, 2026, a date now etched into the recent history of commodity markets, President Trump signed that Section 232 proclamation. This was no minor adjustment. It was a sweeping declaration. The proclamation targeted not just silver, but all critical minerals. This list includes other vital resources like lithium, cobalt, nickel, rare earth elements, and many more. For some astute observers of trade policy and market movements, this was not a complete surprise. The groundwork, as we have discussed, had been quietly laid with silver's inclusion on the critical minerals list. The question was not if such a proclamation might come, but when. More importantly, what form it would take. The market's initial reaction, however, was nothing short of frantic. It was a dizzying surge fueled by pure, unadulterated tariff fear. Just consider the numbers. From January 1st to January 14th, in a mere 2 weeks, silver prices exploded. They rose from $71 an ounce to $93.75 an ounce. That is a staggering 32% jump. It was an unheard of vertical ascent for a commodity of silver's magnitude in such a compressed time frame. What was happening here? It was a classic case of what market participants call front-running potential tariffs. Investors and, crucially, industrial buyers who rely on silver for manufacturing looked at the proclamation. They instantly envisioned a future where imported silver would be significantly more expensive. To mitigate that impending cost, they rushed to acquire as much physical silver as possible before those tariffs could be imposed. This created a massive, immediate demand shock. Picture a global race against the clock. Physical silver began to flow into the United States at an extraordinary pace. It moved from global storage hubs, particularly from the vaults of London, to secure a tariff-free supply. This accelerated migration rapidly depleted European inventories. This made already tight supplies even thinner. Simultaneously, speculative money, sensing an explosive trend, poured into the market. Futures traders, hedge funds, and even individual investors piled into long positions. They were essentially betting on silver prices to continue their ascent. This combination of frantic industrial buying and aggressive speculative long positioning ignited what is known as a short squeeze. For those unfamiliar, a short squeeze occurs when investors who had previously bet against a price increase are forced to buy back the asset at higher prices to cover their losing positions. This forced buying then adds even more upward pressure. It creates a vicious cycle that sends prices parabolic. The effect on silver was dramatic. It was a perfect storm of policy anxiety, industrial panic, and speculative fervor. One of the most telling indicators of this extreme market behavior was the gold-silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. During this period, the gold-silver ratio plummeted to 50. This was its lowest level since 2011. This was not just a statistical anomaly. It was a clear, unambiguous signal of silver's extreme relative strength. It showed the sheer ferocity of the speculative rally. It underscored that silver, traditionally the more volatile but also the more industrially driven of the two precious metals, was experiencing an unprecedented moment in the spotlight. The market was roaring, and $93 an ounce felt like a stepping stone to even higher prices. This was driven by the belief that tariffs were an inevitable certainty. But then came the twist. A sudden, unexpected pivot sent shockwaves through the market, just as quickly as the earlier news had propelled it upwards. On January 15th, a mere 24 hours after signing the Critical Minerals Proclamation, President Trump made a follow-up announcement. He clarified that he would not impose immediate tariffs. Instead, he declared a 180-day negotiation period with trade partners. This period is specifically aimed at finding alternative solutions. It was a strategic pause, a reprieve from the immediate threat of tariffs, but it was also a moment of profound market disillusionment. The market's response to this policy clarification was immediate and brutal. The momentum that had propelled silver to its dizzying heights evaporated in an instant. Silver plunged over 7% in a single day. It dropped from that peak of $93 an ounce to $86 per ounce. Let that sink in for a moment. That is $7 evaporated per ounce overnight. To put it into perspective, a $100,000 investment would have lost $7,000 in a matter of hours. This was not a gradual correction. It was a rapid, painful deleveraging event. Speculators who had piled into long positions now saw their thesis unravel. This dramatic swing highlights the core issue currently gripping the silver market. It is currently dancing almost entirely to the tune of political rhetoric. Investors are not trading traditional valuations or macroeconomic data. They are trading headlines, policy announcements, and, quite literally, presidential tweets. This creates an environment of extreme volatility and unpredictability. Fortunes can be made and lost in the blink of an eye based on pronouncements from Washington, D.C. It is a market driven by the news cycle. This is a sharp contrast to the underlying foundational forces that typically guide commodity prices. Now, it is absolutely critical that we look beyond these daily headlines to understand silver's true fundamentals. Because beneath all this noise, there are powerful structural forces at play. One of the most significant challenges silver faces is a persistent structural supply deficit. Roughly 70% of global silver production is not mined directly as silver. Instead, it is extracted as a byproduct of mining other base metals, such as copper, lead, and zinc. Imagine a giant factory that primarily produces cars. Even if bicycle demand explodes, the factory cannot just suddenly start producing thousands more bicycles. This is because it would first need to significantly ramp up car production. This byproduct nature means that silver output cannot easily ramp up to meet surging demand. This inherent inelasticity of supply creates a powerful bottleneck. It means that the market cannot simply respond to higher silver prices by opening more dedicated silver mines. It also cannot significantly increase output from existing operations. The supply side is, to a large extent, constrained by external factors. This makes it incredibly difficult to close any supply gap that emerges. Meanwhile, while supply is stagnant and inelastic, industrial demand for silver is exploding. Silver is not just a shiny metal for jewelry. It is a critical component in many of the 21st century's most advanced and rapidly growing technologies. Consider solar panels. Each one requires approximately 20 grams of silver. It is used in the conductive paste that captures sunlight. As the world transitions to renewable energy, the demand for solar panels is skyrocketing. With it, the demand for silver rises. Electric vehicles, or EVs, are another major growth driver. An average EV uses between 25 and 50 grams of silver in various electrical connections. As EV adoption accelerates globally, so too does the need for silver. Beyond green energy, the digital revolution relies heavily on silver. 5G smartphones, massive data centers, and advanced artificial intelligence servers all depend on silver's unique conductive properties. These include its unparalleled electrical and thermal conductivity. These are not niche markets. These are multi-trillion-dollar industries growing at an incredible pace. Industrial demand alone for silver is growing at a robust 5% annually. This is a remarkable figure for a foundational commodity. So when you put these two fundamental forces together, you see a powerful structural imbalance. On one side, you have a supply chain that is largely stagnant. It is tied to byproduct mining and therefore unable to quickly respond to price signals or increased demand. On the other side, you have exploding high-tech industrial demand. This is driven by megatrends like green energy, electrification, and digitalization. This fundamental imbalance provides a powerful underlying tailwind for silver prices. This is entirely separate from the political noise we have just discussed. It suggests that even if the tariff discussions fade, the intrinsic value of silver as an industrial metal is on a strong upward trajectory. This is the quiet, fundamental story that often gets drowned out by the daily market swings. But it is the story that, in the long run, holds immense significance for silver's price. Let us now take an even closer look at President Trump's broader strategy. This is particularly revealed in the details of that January 14th proclamation and his subsequent clarification. It suggests that his long-term objective might be more nuanced than simply slapping tariffs. Rather, a key goal appears to be establishing a price floor for these vital resources. The intent here is clear: to prevent countries, particularly economic rivals like China, from engaging in, quote, dumping. Dumping occurs when a country exports goods at prices lower than their domestic market or production cost. This is often subsidized by the government. This practice effectively undercuts U.S. domestic mining operations. It makes it economically unviable for American companies to extract and process critical minerals within the United States. If U.S. miners cannot compete on price, they shut down. This leads to a dangerous dependency on foreign sources for strategically vital materials. We are already seeing this broader strategy in action, extending beyond silver. For example, at the January 12th G7 finance ministers meeting, the United States proposed a rare earth price floor. This was not just a theoretical discussion. It was a concrete step towards formalizing mechanisms to ensure fair pricing and prevent predatory practices in critical mineral markets. Furthermore, the U.S. is actively pursuing bilateral critical mineral agreements. We have seen ongoing discussions and agreements with countries like Australia, Japan, and even Argentina. These agreements aim to diversify supply chains. They also reduce reliance on any single nation. This creates a more resilient, friendly shored supply network. This pattern of behavior indicates a clear preference for negotiated outcomes and strategic supply chain diversification. This is preferred over immediate blanket tariffs. The administration seems to recognize that simply imposing tariffs could disrupt critical supply chains. It could hurt domestic manufacturers who rely on these imports. However, it is crucial to remember that the initial proclamation explicitly states that if these negotiations fail by the July 13th deadline, then additional measures would be taken. This means the tariff threat is not gone. It has merely been postponed. It is now hanging over the market, providing a powerful lever in the ongoing diplomatic discussions. The sword of Damocles. In this case, a potential 75% tariff on silver still hangs. But for now, it is held by the thread of ongoing negotiations. That July 13th deadline serves as the critical moment of truth. What does all this mean for the price of silver moving forward? The immediate future is highly contingent on the ongoing negotiations and political decisions. We can, however, outline three plausible price scenarios for silver. Each has different implications for those interested in this market. Let us start with the optimistic scenario. Imagine negotiations succeed. By July 13th, the U.S. and its trade partners agree on new critical mineral supply chain arrangements, or perhaps they agree on a formal price floor. In this best-case outcome, the policy uncertainty premium that has inflated silver's price would likely evaporate. This could potentially pull silver prices back below $80 an ounce. However, it is crucial to remember those underlying structural supply deficits. Even with the political drama receding, the fundamental imbalance should provide a robust floor. This could keep silver well above $70 an ounce in the long term. This scenario suggests a calmer, more fundamentally driven market. Now consider the base case scenario. What if negotiations drag on without a clear resolution? Perhaps there are extensions or partial agreements. In this environment, we should expect continued elevated volatility. Silver would likely trade in a wide range, perhaps between $80 and $95 an ounce. It would remain highly sensitive to every presidential tweet or every leak from a trade negotiation. This scenario implies a market dictated by the news cycle. Short-term traders might thrive, but long-term investors would face persistent unpredictability. The market would be in a holding pattern. Finally, the pessimistic scenario. Should talks collapse and negotiations fail to yield satisfactory outcomes by the July 13th deadline, President Trump has explicitly stated that additional measures would be taken. This implies the imposition of tariffs. If tariffs are indeed enacted by July, we could see another massive short squeeze. This could potentially drive silver past $100 an ounce. Some analysts are even forecasting silver could hit $150 by year end. They cite the combined impact of the structural supply deficit and the severe policy risk. This scenario would likely ignite another frantic rush to secure tariff-free supply. This would be exacerbated by renewed speculative fervor, sending prices into uncharted territory. This is the scenario that carries the highest risk, but also the greatest potential for explosive gains. It is crucial for anyone watching this market to understand that the recent price action has been heavily influenced by speculative money. It was not solely by underlying fundamentals. A move of that magnitude in such a short time frame is simply not normal for a commodity like silver. Looking at the COMEX futures market, we see that speculative net long positions, essentially bets that the price will go up, have soared to record highs. When everyone is betting on a continued ascent, it creates a market that is incredibly fragile. As we saw on January 15th, one policy clarification led to a 7% collapse. This market can and will reverse course instantly when sentiment shifts. Adding to this extreme volatility is the current state of physical inventories. London's silver inventories, a key global storage hub, have plummeted. This creates what is known as a thin market. In a thin market, even relatively small buying pressure can send prices soaring. This is because there is not much readily available physical metal to absorb the demand. Conversely, even minor selling pressure can trigger sharp drops, as there are fewer buyers willing to step in. This inherent characteristic makes silver historically about twice as volatile as gold. This is partly due to its significantly smaller market size. The annual silver market is roughly $50 billion, dwarfed by gold's $4 trillion market. This means less money is needed to move silver prices, amplifying the impact of both fundamental shifts and, critically, speculative flows and political rhetoric. Given this dynamic and volatile environment, navigating investment options in silver requires a clear understanding of the risks and characteristics of each approach. For those considering physical silver, it offers direct ownership of the metal, a tangible asset. However, it comes with significant costs. When buying, investors typically face premiums of 10 to 15% over the spot price. This covers fabrication, shipping, and dealer markups. When it is time to sell, you will often receive a discount from the spot price. This means the round-trip cost of buying and selling physical silver can easily amount to 20% or more. This eats significantly into potential profits, especially in a volatile market. Silver exchange-traded funds, or ETFs, such as SLV, offer a convenient way to gain exposure to silver without the complexities of physical storage. However, they carry annual operating expenses, typically around 0.5%. While this might seem small, over a decade, that is a 5% drag on your returns, compounding over time. Investors should be aware of these ongoing costs. Silver futures contracts are another option, but these are highly leveraged and incredibly complex instruments. They are absolutely not suitable for most individual investors. The leverage means that small price movements can lead to very large gains and losses. It is entirely possible to lose your entire principal quickly, or even more than your initial investment if the market moves against you. Finally, silver mining stocks offer leveraged exposure to silver prices. A 10% move in the price of silver can often lead to a 20 to 30% move, both up and down, in the share price of a mining company. While this offers potentially higher rewards, it also comes with substantially higher risk. These companies face operational, geopolitical, and management risks in addition to commodity price volatility. The key takeaway across all these options is that timing the market right now is incredibly challenging. Those investors who bought at $93 an ounce are already down 7%. Those who bought at $86 might be feeling good today, but tomorrow is unknown. The current environment demands extreme caution and a clear-eyed assessment of risk tolerance. In summary, silver presents a fascinating dichotomy. On one hand, it has compelling long-term tailwinds. This includes a structural supply deficit driven by the byproduct nature of its production. This meets surging industrial demand from green energy, electric vehicles, and cutting-edge tech trends. These are powerful, foundational forces that should support higher prices over the long haul. But in the short term, the silver market is entirely dominated by extreme policy risk. It is capable of swinging 7% or more on a single announcement or clarification from the White House. Investing in silver right now is essentially a bet on how President Trump will navigate the next 180 days. Will he ultimately impose tariffs, creating a new floor for prices and a potential short squeeze? Or will negotiations yield a compromise, perhaps a price floor without direct tariffs? This might temporarily remove some of the policy premium. The July 13th deadline is the critical juncture, the moment of truth that will likely determine the market's trajectory for the remainder of the year. For investors considering their next steps, we have a few pieces of actionable advice. Remember, this is not financial guidance, but rather important considerations for your own due diligence. First, consider checking your allocation. If silver currently represents more than 10% of your overall investment portfolio, it might be prudent to consider reducing your exposure. The current level of volatility might simply exceed your personal risk tolerance. Diversification remains a cornerstone of sound investing. Second, for new entrants to the silver market, we strongly advise exercising extreme caution. Rather than jumping into the fray, observing from the sidelines until the policy uncertainty around July 13th clears is a completely valid and often wise strategy. There is no shame in waiting for more clarity. And for existing holders who are sitting on gains, think about taking partial profits on rallies. Perhaps selling 1/3 of your position if silver rallies above $90 and another third if it breaches $95. Do not let greed turn paper gains into real losses from a sudden, sharp drop. Secure some profits to mitigate your risk. Silver is, without a doubt, a long-term strategic asset with incredible fundamental potential. But right now, it is a speculative playground, a Wild West show driven by political pronouncements and rapid shifts in sentiment. In a market moving 7% on political statements, the odds are stacked against individual investors trying to time the market perfectly. The numbers do not lie. The jump to $93 and the immediate drop to $86 is the stark, undeniable reality of today's silver market.